Investment is a profitable way of making wealth. Investment is something you do to make money while you yourself are busy in doing something more important for yourself. Consider having a vacation with your family while the investment you've made is generating money for you. Sounds pretty interesting, right? This is exactly what investment does. However, there are certain factors that an investor must know before investing somewhere. In this video, we'll share some psychological tricks and lessons with you that an investor must know to make maximum money out of an investment. Following this lesson, you can gradually become a good investor who knows how to draw maximum profits. Don't forget to watch the video till the end so that you don't miss any of these amazing facts that we're about to share with you today. So hold on tight and let's get started right away. The first lesson for you as an investor is that you should risk only what you could afford to lose. Risk is the natural factor that comes with an investment. You never know if your investment is going to pay you back or not. Even if it does give you returns, you can't be sure if those are what you expected or not. In other words, investment is always risky. The main lesson for you is to take a calculated risk. For instance, invest somewhere that will most likely multiply the returns. As they say, don't chew more than you can bite. The same goes with risk-taking an investment. When you take a risk that you cannot afford, anxiety and tension will follow you. For instance, if you've invested $10,000 in the stock market and you come to know that the market is going down, you would likely take your money out to avoid any further losses. On the other hand, a seasoned investor wouldn't rush into making decisions. His risks would be calculated, and so would his other market-related decisions. The second lesson you need to learn before making any investment is patience. Yes, you should be patient while the investment starts generating returns for you. Castles aren't built overnight, you know. Important things take time. Getting profits out of your invested money will certainly take some time. As an investor, you should learn not to panic meanwhile. As Warren Buffett once said, that if you cannot consider holding a stock for 10 years, don't consider holding it now. If you're expecting to get a double of your money overnight, don't invest. Since nobody can predict the market in the best possible way, things can be uncertain at times. However, those who expect to double their profits in a matter of a few days are the ones who take irrational decisions. In other words, patience is the key to making significant profits. In short, you can't make all the fortune you want by just one move. Rather, small and decisive steps taken carefully can ensure success. Consider the fastest man on the planet. We know that this person didn't win the title in his childhood and most probably not even in his teenage years. At adulthood, his goal of winning the title of the fastest man on the planet would have been achieved. That means we have to take small and simple steps and learn every day from our mistakes. Start your investment in little chunks so that you would know the tricks in investment business. If you plan on making a huge investment without any prior experience, it could cost you your entire wealth. So the lesson is, don't be in a hurry. Instead, learn from your own experiences. Our next lesson for you is to protect your money. A huge factor of failure to get any profits by investment is that the investors don't know how to protect their money. Two principles must be followed while doing an investment. The first principle is to never lose money, and the second one is to never forget. Yes, not losing money is a principle that ought to be followed in an investment. Your money is of great value, and of course, you haven't invested it to bear any loss. So try investing in businesses that have a high success rate instead of those where the odds are not in your favor. Don't forget the lessons that you learn along the way. A combined approach of making efforts of not losing money and never to forget the causes of any loss that you once had to bear can ensure your profits the next time. In other words, just go with the flow when it comes to investment in the market. The next lesson for you in making an investment is never to submit to greed. As they say, be fearful when others are greedy. Submitting to greed can make your investment a total loss, since greed pushes us towards hasty moves and decisions that are prompt. Most of the time, greed yields failure. Usually in the market, the early investors are the ones who make the most profits. Others that follow suit out of greed usually find themselves unable to extract maximum profits. So we'd suggest you stay away from greedy temptations and invest your money by rational decisions. If an investment sounds too good to be true, you should probably do a little bit of your own research and find out if all the fuss is actually genuine. Only then should you consider putting your money as an investment. Always remember that you should know to make losses for your own advantage. Learning from failures is the best thing one can make out of them. Sometimes loss in the market is taken as a setback by the investor. Without doing any research due to the cause of the failure, the investor forgets that losses too are part of the business. We already know that no one can predict the market accurately. The earlier you learn this lesson, the better it is for you. Learning from your losses and then investing is what shifts the scenario more towards profit for the investor. Another important point is to try to mitigate the risk as much as possible. For instance, investing all of your money in one place can amplify the risk factors. Rather, you should do proper research before doing that. Consider at least 2 to 3 places that can provide you good returns. This way, the risk of getting losses in the market will be minimized. By doing this, you can spread out the risk factor. By diversifying your portfolio, risk mitigation can be ensured properly. For this purpose, you can invest in different industries. For instance, Apple and Microsoft are both from the same industry. Bad performance in one will probably affect the other as well. So in order to spread out the risk, you can invest in another industry. This is how market strategies are decoded. It needs time and experience. Again, prompt decisions cannot bring you any good in this matter. Taking every move calculated with measured risks can ensure profits for you. In the case otherwise, you might have to suffer loss. The last and very important lesson to learn for an investor is to understand that dips are a part of investment in the market. Mostly what happens is that when a market goes down, most people sell off their shares at lower prices. Without understanding the dip, they try to mitigate any further loss. However, it is a fact that people who don't hastily take the money out are the ones who get the most profits. For instance, if you've bought a share of $100, then in case of a dip, you'd probably rush to sell it for $80. When most people do that, those investors get the profit who waited patiently to let the market rise again. Again, patience is key. Making rational choices can ensure you profits in the long run. On the other hand, reacting abruptly is often counterproductive. To conclude, investors need to know that risks are always a part of investments. A successful investor is one who knows the market strategies by learning from their own experience. Making an advantage out of one's loss is what produces successful investors. In other words, rationality and patience, along with some experience and caution, make the recipe for a successful investment. See you on the other side, guys. Thank you so much for watching, and don't forget to subscribe to this channel for more amazing content every week that will help you increase the pace of your success and wealth.